Today's Business Channel.
So, here we go. Hello, and welcome to Your Money, Your Call. I'm Julia Lee from Bell Direct. If you have a question about shares, our phone lines are open, and now's the time to give us a call on 1300 30 34 35, or if you prefer, you can always email us on yourmoney@skynews.com.au. And joining me on the panel tonight, we have Evan Lucas from IG Markets and also Marcus Hughes from LHC Capital. The market's been reaching 5-year highs, so I guess the big question is, have investors, traders missed out on the rally, and what sectors and what stocks should we be looking at? Let's ask both of our panellists. Now, Marcus, congratulations. You were a finalist in the Hedge Fund Awards.
I was, yeah, and it was a great for you one. It's good.
And first time on the show. So tell us a little bit about your fund, LHC Capital.
So LHC Capital is a high conviction hedge fund which I run with my business partner and our investment team. And what we do is we build portfolios in companies we think are outstanding with some kind of sustainable competitive advantage, which we think are fundamentally mispriced.
Okay, so we look forward to hearing about some of your investment ideas throughout the show. And Evan, I mean, you're looking at the market all the time, and the market's been running pretty hard. A lot of people saying, the banks are overvalued and we're due for a pullback. What do you think?
Yeah, look, having a look at the market as it currently stands, 5-year highs, it does also have a lot of probably what I'm calling sparks coming up in the next couple of days. Most notably, we are on the eve of the FOMC meeting tonight. That will be very, very interesting come sort of Thursday morning. The expectation is for $10 billion of tapering. The markets globally look like they'll actually take that on the chin. So it may be moderate. It may not actually be as bad as we expected. And if we can get past this current sort of taper talk and we see more and more good news coming out of Asia, particularly China and Japan, we could actually start to head to sort of the 5,400 level that a lot of people were hoping we could get to by the end of the year. So 5.5-year highs. I think it may sustain if we can get past the taper over the next couple of days.
Okay, so lots happening in terms of the market, and of course the US Federal Reserve meeting, that's going to be an important one. But let's kick off the show with an email. We've got a viewer email from Jimmy, and Jimmy writes, "Hi there, Julia and panel. I bought some cab charge because it has fallen quite a long way, and it has a really big dividend yield of nearly 9% fully franked. Does anyone on the panel have any thoughts about how high this stock could go? Many thanks." Let's try and bring up the stock price chart for cab charge, because it has been a pretty turbulent ride, I think, for cab charge. It's lost some of its contracts in terms of the buses, and of course, I think its business coming under fair bit of pressure. I was reading this week that GoCatch, which is a competitor now to cab charge, is being backed by Packer, so a bit of competition emerging in this space. I mean, Evan, looking at cab charge, what are your thoughts on this one?
Look, the way you also have a look at cab charge also probably got caught up a little bit in the McMillan Shakespeare idea as well. It's also had a bit of issues with its technical side of the business. It is also lagging behind where we've also seen some of the other major packaging ideas. Looking at the chart and where the chart's been sitting, it has been under a real amount of pressure. It continues to move slightly lower, and it's been fairly rocky over the last couple of weeks. As a personal take on where I see cab charge still has a long way to go. It's got a lot of lower end competitors coming into that market on the bottom side, and if you want to look really, really basic and have a look at the whole idea, if you get into a cab these days, you can actually see that there is always a competitor market in the cab itself to the original sort of network that cab charge had. So it's a very, very tough business at the moment, cab charge. It does have a good model, I do understand that, and it had a first mover advantage, but it is under pressure, and for that reason I'm very nervous about where it's actually heading.
It's a really good point. I mean, cab charge, it had a virtual monopoly for a while, and then now you get into a cabs and they have two machines. One's a cab charge machine, and one might be from Suncorp Metway, which splits the commission that it receives on those machines with the actual cab drivers. And then you have GoCatch, which is an app that you use on your phone that charges the cab drivers, $5 and sends your details over, and so more competition coming in this space.
Well, it gets even worse, actually.
Oh, really?
For cab charge, unfortunately. Just this morning, I got an email from Uber inviting me for a free taxi ride for $30. Google Ventures has just invested $200 million into backing Uber globally. It's a fantastic app. So technology is disintermediating cab charge. The Victorian government is regulating against cab charge. And what cab charge has is a business with really high fixed costs, which was great when revenues were growing. But unfortunately for cab charge, revenues are now in structural decline. As you said, competition is entering the space, and this isn't one for the champ.
Okay, and I guess looking at the dividend, the dividend yield is also dependent on earnings. So a company like CabCharge, as you see earnings deteriorate, do you start to see dividends also deteriorating?
Absolutely. I mean, a high dividend really should be viewed as the market questioning the sustainability of that payout ratio. So I think in this case, often the market leads analyst forecast numbers down ahead of time, and I think that's happened. CabCharge actually just recently cut their dividend, and I think with the amount of debt that they have on the balance sheet, I think there's probably further dividends and further headwinds to come for CabCharge.
Okay, so that was CabCharge. Look, it looks like both our panelists a little bit negative on CabCharge given the competition that it is in that space at the moment. Let's go to our first caller of the night. Neil, welcome to the program. What's your question for our panel tonight?
Hello, Julia. My
Hi,
stock
Neil.
is Food and Food Group, FNP, please.
We've lost Neil.
What's Neil?
But I guess just talking about the market and valuations on the market, especially in terms of the banks. This is an area that's been very much in focus. There was a hedge fund conference over in New York talking about, the Aussie banks being overvalued, and if you want to play the emerging market story, then short the banks. I mean, you're in the hedge fund area, Marcus. Is this the view that you have?
Look, I am in the hedge fund area, but what we do is we only make investments where we feel like we have additional insight over everyone else. So I can provide market commentary, but I can't provide a really strong view. I think it's hard. Shorting is a really difficult business unless, like the last call, it's something structural where you're seeing cash flows going down with CabCharge. In a low interest rate environment, I think macro policy settings are really favourable for equities, for all asset classes. So, the American hedge funds have tried shorting the Australian banks, and they got hurt pretty badly. Australian property, outlook for Australian property looks quite reasonable. That's not a trade that I would be putting on.
Okay, what's your thoughts?
I might tell you exactly what Mark's saying. There is definite Burt fingers coming out of that conference in New York, and it made a lot of headline news. This isn't a new trade, and it isn't a new sort of comment that we're seeing coming out from the hedge funds, particularly regarding the big four banks here in Australia. There is always this concern that they are over-leveraged to Australian real estate, and particularly retail real estate. You've got to look at how the market is structured compared to what they normally work in, and these hedge funds particularly work in Europe and also in the US, and the population disbursements across there and their real estate markets are very, very different. We have 88% of our population in the big cities. We have an undersupply issue of roughly around about 11 months per that undersupply, and for that you can understand why the house prices are where they are. We also have tax sort of thresholds that also help out our sort of current property prices. A lot of people are calling about negative gearing and whether or not they actually move away from it. It would be a real problem if we did, and for that reason the political nous to do that I think is very, very tough. So it's all very supportive therefore of the banks, and that's why the yield play, as Marcus alluded to, was very good over the last 24 months, but also why they're probably going to be sustained over the coming period of time because of the situation we currently have, where retail in this country is still quite strong even with a weak economy.
Okay, so that was the banks. Let's try and get back to our first caller, Neil on the line from Geelong. Neil, do we have you there? It doesn't sound like we have, Neil. It looks like we do have some problems. We are going to go to a very short break, but we'll be back to answer more of your questions in just a moment. Stay with us. Welcome back to the program. Now, before we go back to the callers, let's go to the stock watch, and we're going to start off with Evan. Evan, what stock are you watching?
Look, the stock watch that I'm having a look at today is actually ResMed. The reason for it is there's two major events coming up, and that is the Fed we alluded to before, and it has a huge FX tailwind behind it. 60% of its EBIT comes out of the US, and it has 95% of its earnings coming out of the globe. It also has a very, very strong niche market in that sort of sleep apnea area. Their face masks are on the way up. We also saw very, very good results coming out in August. The momentum at the moment is well and truly behind the stock. It is reaching all-time highs, and it hit it again today. We really do like the whole idea of that kind of stock play. From a chart idea, you'd want to have your stops in roughly around about 620 to 630. Watch ResMed really moving up high.
And remember, we're still taking your calls, and the number to call is 1300 30 34 35, and your emails on yourmoney@skynews.com.au. Now, before we went to the break, we were talking to Neil, and unfortunately we missed this question, but I think he was calling in about Freedom Foods. So let's talk about Freedom Foods. FNP is the stock code there. Now, Marcus, looking at Freedom Foods, it's a relatively smaller company, market capitalization of $120 million. We've just got the chart up there. A massive performance, up 260% in the past 12 months. Now, is this a stock that you'd be getting into? What are your thoughts on that?
It's actually a stock I own already.
Oh.
I should make that disclosure. It's a great company. It's really unique. It has, well, for those viewers that don't know what it does, it has two main businesses. It makes allergen-free, gluten-free, nut-free cereals, and the demand for that really is extremely strong at the moment. And they're the market leader in Australia, and they're distributing their products now very successfully, albeit in its infant stage in America. And they also have a packaging business which specifically takes Australian milk, puts it through a UHT process, and ships it to China, clipping the ticket on the way, where milk sells for multiples of what it does in Australia, sort of fourfold. It also has a stake in A2 milk. Just raised some money. It was very there's over $100 million worth of demand for the $28 million of capital that it raised. And it really is one of the businesses in Australia in a unique position where it has several company-changing growth options. So.
Okay, so you own this stock, Marcus.
I quite like it.
You obviously like the stock. Now the stock's at $2.60 at the moment, so it's seen a rise of 60% over the past 3 months. Would you still be buying the stock at these levels?
I would.
Okay, so liking FNP. Evan, how about you?
Look, I'm going to take it from a different perspective. I'll look at it from the chart idea and what we can see on the charts. Particularly over the last 12 months, it has had an unbelievable run. It's really, really moved up. The volume behind it, look, on a stock this size, is never going to be huge, but you can tell every time it's tested the lows, it's bounced off very high and kept going up. It's again up in an upward channel. I agree with Marcus. If you were looking at it from a chart point of view and buying it on momentum, it's definitely there. The volumes have also increased over the last sort of 2 and a bit weeks. Again, sort of brings back to the whole idea that it is on the way up. Be aware that a stock like this that does have this low volume does have huge price action changes. So just be aware of where your stops are sitting, particularly your stop losses. There could be a fairly sharp pullback, and you could be talking fairly large percents rather than sort of 0.5%. But in terms of the chart, it does look like a good story. And for that reason, on momentum basis only, you'd probably be looking at getting in and maybe moving out around about $2.75 or $2.80 on your stop idea. Okay,
so liking FNP both from a technical and from a fundamental view. Let's go to our next caller of the night. We've got Adam on the line from Victoria. Adam, welcome. What's your question tonight?
Yeah, hey Julia, hey guys. I bought this stock back in June called AMA. I bought it for about 28 cents. It's about 35 cents. I'm just sort of wondering if it can keep going on or what I should do with it, really.
Okay, so we're having a look at AMA, and I think they operate a chain of collision type of outlets. So I guess in terms of its business, a little bit similar to ARC, which has been doing quite well on the market. AMA, if we can bring the stock chart out, we might actually start with Evan and get a technical on this one. I mean, the stock is up 75% over the last 52 weeks, but there's been a bit of volatility there as well. So at this point in time, how are the technicals looking?
Yeah, having a look at the technicals and probably having a look over, particularly through July and August, it had a fairly strong resistance level at about 35 cents, and you can see that it got up to there, hit it 4 times and came back off. Since then, obviously, it's reported, it has come out with what looks like a relatively good report, considering the way the stock has done, and it's jumped above that resistance level. In saying that, we have now seen it come back, and that's probably something to be very, very aware of. If the resistance level has been tested, it's tried to go ahead, it hasn't made it, and it's now coming back. You would suggest that it may actually come back to that lower area of 30 cents over the next sort of couple of months, looking at where the market is going. I don't think, looking at that chart, that it's probably going to hit into the 27-cent mark, where it was pretty much the sort of the low it had at the start of June, and that's when the market was at the low. So you've got to also remember a small cap stock like this does follow the whole general market. So from a chart perspective, it'll be interesting to see if it can bounce above that 35 cents again. But having a look at the movement that it's currently got, it does look like it may actually drop below that again. I'm sorry.
Okay, so AMA, from a technical viewpoint, there might be a little bit of weakness. I mean, having a look at the actual company and what I believe that the company does is looks after, after you've bought a vehicle and say you've had a crash or you need to get your brakes fixed, looks after that. But I think there's a real WA focus. Marcus, having a look at a company like this, and is this one that would interest you?
Yeah, look, again, it's one we own. It's a good business. A lot of businesses that have been car focused, be it ARB, be it AMA, be it automotive holdings, be it anything really has done very well because just car sales have been so strong. This business is pretty capital light, pretty cash generative, and I think it's on the acquisition hunt. So I'd watch for that.
Okay, so you like the stock? You'd be buying the stock at these levels?
Yeah, we like it.
Okay, and you already hold the stock.
Yeah,
but on the charts looking a little bit vulnerable. Let's go to our next caller of the night. We've got John on the line from Brisbane. John, welcome. What's your question tonight, Prav?
Good evening. I just wanted to ask the panel, I've got a self-managed SUSA fund, which I've got all the banks in Australia in it, but I'm trying to diversify, and I'm looking at toll transport and net cash.
Okay. So having a look at, I think, Toll as well as Metcash, MTS is the stock code there. And Toll Holdings, recently during earnings season, we saw the stock coming out with not a great result. I mean, the transport business is about 60% of its earnings before interest and tax, and that only saw around about 2% growth. So we know that certain sectors are doing it tough. We know that the resource sector is doing it tough. Retailing is still doing it tough. So a logistics provider like Toll is having a bit of a difficult time. But, the stock price has been rising over the last 5 to 6 months. What's behind the rise, Evan? And, are you positive on this stock?
I'm very sceptical with regards to Toll, and the reason behind it is that it is currently running the coattails of the whole general market. So the rise that you've seen over the last sort of couple of weeks, John, I think is more to do with that, and you can see that with the sort of the price movements and the fairly sporadic price movements that Toll has had on the chart. Having a look at the Toll business, it is an interesting business. That transport division, as Julia alluded to, is one that has been under a reasonable amount of pressure. You have also got increased competitors coming into the market with Toll, and they've been battling that not just for the last couple of years, but for a fair while now, and they're still trying to get over, particularly their air freight business is one that's very, very much under pressure, and even that major forward freighting business as well on the truck front has been one that's been a little bit behind. And if you're looking at it from a diversification point of view, I think there's better opportunities in the cyclical stocks that you may actually find outside the transport industry completely. So that's outside of transport, outside of things like the airlines as well. If you are looking, considering how moderate you sounded in your voice, it may be something to have a chat to your broker about. Maybe look at other cyclical areas not in this sort of space at this current time.
Okay, so, I mean, Toll Holdings is often thought of as a bellwether because it covers so many different areas of the economy. Is this one you'd back? You like to sometimes back the ones that are looking like good value. Certainly the share price has fallen a lot here. Would you do a contrarian play on this one, Marcus?
No, I wouldn't. I think it's a barometer on the Australian economy. I think it's reached its market share potential, and it's just going to take market growth. So it really depends on your view on the Australian economy. Personally, I think you can do better on that, and I think you can do better on Metcash as well. I think the business faces structural challenges. They've just come out with a profit downgrade. We're actually looking at it from the short side. We think their grocery business has been going backwards for some time. We think that they've been covering up a weak earnings performance in making acquisitions in often unrelated areas, such as coffee shops and actual automotive businesses as well. You change of CEO is always a red flag in a company, particularly if he doesn't join the board, because the chances are he'll be selling all his stock. So,
wouldn't you also agree, if you've got a company that's getting into a business that it doesn't actually know, like the automotive business, is always a bit of a red flag. That
that's not good.
It's just a red flag. So hang on a minute. Why is this business doing what it's doing?
You're also the poor cousin competing against Coles and Woolworths.
You are indeed. And the poor little cousin at that.
Yeah.
So we don't like the supermarket wars. We don't like Metcash because of the challenges it is facing in the near term, because new CEO getting into some businesses that it doesn't know too much about. Looks like both our panelists not liking Toll either. Let's go to our next caller of the night. We've got Annabelle on the line from Sydney. Annabelle, welcome. What's your question tonight for our panel?
Thanks, Julia. Hi, Julia. Hi, everybody. I just recently bought some stock in Main Pharma. The ticker is MYX. and I'd be interested to get the panel's opinion on the stock and where you think it might go from here.
Sure. Well, first of all, Annabelle, congratulations, because this is a stock that's just been going up and up and up. We've just got the stock chart up there. Very impressive performance. The stock's up 114% over the last 12 months. Now, I guess the drug industry has been quite a difficult one. Pharmaceutical area has been a difficult one since the global financial crisis, but it looks like this is one stock that's been doing quite well. They develop, manufacture, branded as well as generic drugs. So, Evan, looking at this one, you'd have to ride the momentum, wouldn't you?
Yeah, Annabelle, I've also got to declare a little bit of an interest here with Main as well. I've actually had Main shareholdings for quite a while, and the reason for it is that I actually was part of Faulding Pharmaceutical way back in the day. So I actually have the shares from way back then. It was given to me by my father, who was actually one of the managing directors there. So I've got to be honest with the panel and also with you at home to understand why I quite like the stock for obvious reasons. It's really starting to hit its straps. That healthcare space indeed is on the way up. It also has now got its distribution arm over in Europe and the US, now starting to really tick along, and quite nicely too, to say that. From a chart perspective, and that's what I'm going to take from tonight, it does look quite positive. It is moving from the left-hand corner to the right-hand corner, and from a very simple chart idea, that is a nice thing to see. But I do also like to see that they are starting to really ramp up that South Australian distribution arm. We are also seeing the generic brand really moving forward quite strongly as well, and that's all good in terms of a really base story for where pharma's sitting. I like the Main logistic idea as well. It's another part of the bolt-on story to the whole pharma story. It's an interesting stock. You've done very, very well. Be aware, and this is something that some people get caught with a stock like this. Know where you want to get out, because that is the catch with a stock like this. It's a fantastic story from a 52-week perspective, but over a longer-term perspective, and again, speaking from experience, it hasn't been fantastic. So be aware. Don't be greedy. Look at where you want to get out.
Well, I'd say actually look at the cash flows. Just watch the cash flows the business is generating, and allow that to drive your decision.
So, Evan, now I know why you're buying up property in Melbourne. The main shares have been doing, Main Pharma have been doing extremely well. MYX is a stock code. You'll notice that there's a negative PE there because net profit was a negative this particular financial year, but it does look like that was due to adjustments. So if you have a look at the sales revenue, that was actually up by a massive 60%. On that note, we're taking a short break, but we will be back to answer more of your questions in just a moment. Stay with us. Welcome back to Your Money, Your Call. Now, before we get back to the calls we have waiting, let's go to Stockwatch. And this time it's Marcus's turn. Marcus, what stock are you watching?
Well, Julia, the stock I'm watching and buying is eMerchants. It's a small cap company. It has a unique piece of technology which really enables petty cash to be managed efficiently by companies, and for governments and charities to make disbursements in a really efficient way. They've got great controls. They've got great reconciliation engines. The great thing about it is it's a small company. It's got a very fixed cost base, and it operates in a very large market. The prepayments market in Australia is over $50 billion. They're the key player, and they're tiny. So I think this can be a very large company, and that is the stock that I'm watching.
Okay, so eMerchants was the stock that Marcus has picked for the show tonight. If you have a question about a stock or shares, our phone lines are open, and we would love to hear from you. The number's 1300 30 34 35, or you can also email us on yourmoney@skynews.com.au. It's actually now time for a viewer email, and this was actually one that Shane also tweeted to Evan and I during the day. So we're a little bit prepared for it. Marcus may not be, but let's have a look. Hi, could the panel please give me their thoughts on Mint Wireless, which is a global mobile payments and transactions processing company. They recently signed a 5-year deal with MYOB and certification with the Bank of New Zealand and Bendigo Bank. It looks to be an early mover in the mobile payment space. Thanks from Shane. I mean, talking about competition, there's so many players entering into this area now. Evan, what's your thoughts on this one?
Yeah, look, Shane, when you sent through the tweet, I had a fairly good read up on it. It is a very, very small company. It's $8.8 million in terms of market cap. So it is in its infancy, and it has been listed for over 5 years. But in saying that, those two signings alone with MYOB and also the Bank of New Zealand is a big, big step forward in terms of where it's going. I'd have to agree it's an infancy call. We would need to see some really good revenue streams coming from that market, because those kinds of players, if they don't agree with it or it doesn't actually work, will probably drop it quite quickly. But in saying that, you can see the price action that happened when they went into their trading halt to announce that Bank of New Zealand movement. It jumped up 5 cents, which is a really, really strong 25% move on a company this size. Be very, very aware that if you are going to get into it, it's still got a long way to go. And you can see that the technology, which they have got out of the US, is still not completely integrated consistently, and for that reason, just be aware of that. But it does look like a good news story if they have managed to sign on those kind of companies like MYOB as well, and if they can get that micro sort of side of the business, it could be a niche little area that they could do relatively well at.
So it sounds like you're getting in pretty early at a time when the share price has had a very impressive performance. The last 12 months, this stock is actually up a massive 775%, and in fact, just over the past 1 month, the stock's up 400%. So I guess the question is, Marcus, are you too late to the game, or are they going to continue growing revenue and getting some of these big deals across the line, like MYOB and like the one they've done in New Zealand?
Look, I don't know the details of this company, but what I do know is that there are a lot of very well capitalised global players looking very, very closely at the mobile payment system, and I'm pretty sure Mint Wireless isn't going to be the global winner. So I would say, well done. I hope you own the stock. Good on you, but don't fall in love with it. What they have is a first mover advantage, and that's going to disappear.
Does it mean that they're perhaps a takeover target, though, by one of the bigger players who want to get
Possibly. Could be.
So you'd be cautious with this one?
I'd want to understand how replicatable what they have is before I bought it.
Okay, so that was Mint Wireless, a very impressive stock price performance. Stock code was MNW if you were interested in that one. Let's go to our next caller. We've got Glenn on the line from Sydney. Glenn, welcome to the show. What's your question tonight for our panel?
Oh, hi, Julia. My question is in regards to ARRIUM, A-R-I. I got into that around about 80-odd cents, and it's had a really nice run. I'm just wondering whether panellists think that it's got more legs. And if you have time, I noticed, like Charlie Aiken was on Switzer last night talking up the prospects of David Jones, so that would be of interest to me as well. Thank you.
Okay, so let's start off with ARRIUM. ARI is the stock code. I mean, this is a stock for many, many years. Nobody wanted to touch it. Suddenly the stock's moving. ARRIUM, BlueScope Steel, they're both doing well. Is it time to get back in on some of these unloved companies that had been doing it tough? The Aussie dollar's falling, moving in their favour. Do you believe in the steel business or the iron ore business?
I'll take it from two parts. Looking at it from a chart point of view, you can see Glenn, you've done fantastically well. You've basically picked it up almost at the low of the year for what they've done here, which was back in June, which is when the whole market was there. The whole cyclical side of the market is on the way up, having a tear, and from a chart perspective, it does look quite nice. It continues to punch through resistance levels, and it does look like it's now gone past the high of the year as well. Moving to the fundamental side, the catch that comes with the steel plays, particularly here in Australia, is that they are still highly leveraged to what goes on in China, and they are still well and truly high on the cash cost sides. We're seeing iron ore remaining stubbornly high at around about 135 to even as high as 137 US dollars a tonne. And considering that the Chinese are still willing to buy up iron ore at that, and they produce steel at a lot cheaper cost, that may come in to be a fundamental difference over the year. And if the fundamentals start to take over, and you can see it also in BlueScope as well, that may be a bit of a reason why ARRIUM comes back. The results they came out with in August were okay. They were slightly below, but in saying that, they did actually finally manage to register a profit, which was nice to see as well. And the rebranding from One Steel has done them relatively well. But in saying that, if you look at where they're at, they are teetering at the top end of probably where you want to be, and you may see a pullback over the coming months.
Okay, so Marcus, looking at this stock area, what do you think about the steel industry, iron ore? Prices have been holding up relatively well. Do you like the commodity space?
No, I don't like commodities. I can't forecast them 3 years forward, so I don't really play or look at commodities. I think your view on ARRIUM should be dictated by your view on iron ore, and if you can predict that better than the Chinese, good luck to you.
Okay, let's move on to our next call. I've got Glenn on the line from Perth. Glenn, welcome. What's your question for our panel tonight?
Well, I was going to talk about AGO, but apparently you've just answered that one in a roundabout way. I like ECQ, Biomed, and similar to the caller before, the graph has gone stupid just recently.
Yes.
Do you guys know anything graphically or anything about ECQ?
Okay, so looking at ECQ, I think it's called EcoQuest. I've just had a couple of friends who've had babies, and you know, those babies use a lot of nappies, and I think what EcoQuest does is biodegradable baby wipes as well as nappies. They may also have a stake in a company that has is involved in stem cells for regenerative purposes. I also have a lot of friends, you know, elbows, tennis elbows, having knee problems from exercise as well. So EcoQuest, a very small company. The share price has been running over the last 6 months. Do you follow this biotech? It's very tiny. It's, I think, an $18 million market capitalization.
Look, it is small. I mean, I think what you want to do, Glenn, is have a look at how the balance sheet has been structured, and if they have enough cash to sustain their operations and to conduct the trials that they'll need to do in order to advance, you know, the field that they're operating in. So, you know, I think you should keep an eye on that.
Okay, and looking at the charts.
Look, looking at it from a chart perspective, it's also a little bit concerning that the volume going through it is incredibly low. You can see, you know, several days where it doesn't actually trade. So that is always something to be aware of. And from a chart perspective, it does start to really, you know, move around where you're actually looking at your resistance and your support levels. You can see since it had a relatively okay report that came out on the August 27th, that's when that rally really started to kick off. It has moved up, but you can see that it's already starting to hit more resistance at 30 cents. It's been a good run, but it does look like, looking at the chart this morning, it is moving in the other direction.
Okay, on that note, we will be back with more after this very short break. If you'd like to speak with our expert panel, please give us a call. The number's 1300 30 34 35, or you can also email us at yourmoney@skynews.com.au. Welcome back to the program. Joining me on the panel tonight, we have Evan Lucas from IG Markets and also Marcus Hughes from LHC Capital. So if you've got a question you'd like answered, please give us a call on 1300 30 34 35, or you can also email us on yourmoney@skynews.com.au. And we've got Vivian on the line from Sydney. Vivian, welcome to the show. What's your question tonight for our panel?
Yeah, hi. My question is about MCMILLAN and Shakespeare. After the election, we bought some stock thinking it was going to soar. And, well, actually, it's going south instead of going north, something.
Yeah.
So just what's going on, if anybody can help?
It's a good question coming through from Vivian on MCMILLAN Shakespeare, because, you know, pre-election, this is a company that was absolutely soaring. I think from that July announcement where the stock plummeted 42%, we actually saw the stock 50%, up 50% by the election date. But post-election, you know, we've seen quite a bit of selling happening. Why is this the case, and would you be buying MCMILLAN Shakespeare at the moment, Evan?
Having a look at MCMILLAN Shakespeare, I can understand, Vivian, why you got caught up in the whole story, particularly around the election. You've got to have a look at the whole idea that over those 5 weeks, particularly before the election actually happened, most people were actually using it as a binary play, and that's a really unfortunate thing for equity investors, particularly those people that use that word as investors, because it was a trade to play off against the election. It was almost like a betting mechanism that you could use.
Having a look, it was pretty crowded as well.
It was very crowded.
Everyone
hugely
was putting
crowded.
it on, laying labour off.
There were even some hedging ideas, you know, with Betfair and hedge your position and then buy the stock on the market.
And you could do a combination of both. And that's what's happened. You've seen the crowded trade unwind, and that's why you saw probably over the last week and a half that unwinding. Not only that, you've now got to look at the fundamentals, and if you have a look what happened when the FBT tax was announced from the former Labor government, that changed the fundamentals of the stock as well. Goldman Sachs estimate that it could have taken 35 to 40% out of its NPAT if it kept going with the way it had. And
Rod's proposals would have killed them.
It would have killed them. And not only that, the way you look at it is that you now have a situation where that was actually factored into the stock, and that was factored into the underlying business. People weren't renewing their contracts, and that's now coming into the share price. So you've got a combination of unwinding, Vivian, and you've also got a combination of the fundamentals now crashing into the stock as well. So interesting story. Be very, very aware. MCMILLAN Shakespeare does have those overriding factors on a short-term basis.
Would you be buying the stock?
Probably still not yet. If it came back to around about $11, then yes, I'd be looking at it. It's a very good business, but I still think the unwind hasn't finished, and that's what we're seeing.
And the unwinding is because of the trading positions that have built up in the stock. So traders, when they're selling out of the position, selling pressure comes in, stock goes down. Would you be buying it, Marcus?
I'd be looking at it. I wouldn't be buying it just yet, and that's not our style. We do a lot of work before we buy anything. But if the Liberals do come out and articulate their policy on salary sacrifice and a commitment to the industry, then it'll be operating effectively under the same set of rules that it was when it was valued at, at similar levels and growing very strongly. So, no, I think it's too soon to throw it out.
Okay, so that was McMillan Shakespeare. Before the election, it was all a binary bet, just one way or the other on who got into power. And of course, with the Liberals in, it's looking pretty good for McMillan Shakespeare. Now trading on fundamentals, but the market probably issuing a discount for the stock given the regulatory uncertainty that has entered into the stock. Let's go to our next caller. We've got Sam on the line from Melbourne. Sam, welcome to the program. What's your question tonight?
Good evening, Julia and panel. Question with respect to Voyager Resources and Stanmore Coal, two stocks that I got caught up in a year or two ago. So interested to see what position I should be exiting out of.
Ouch. Sorry, I just had a look at the stock price chart for Voyager, and it doesn't look pretty at all. And looking at Stanmore Coal, we know the thermal coal space has been a difficult one. So given the stock price movements that we've seen in these type of stocks, Evan, how do you manage the psychological impact of being in a stock that's fallen this far? I mean, is it worthwhile getting out at all with, the small...
Yeah,
levels?
Sam, look, it's an unfortunate place to be, and you probably moved too quickly, and that's, that's an unfortunate thing about what's happened. I think also you've got to look at the two kind of companies that you're investing in. If you look at Voyager, yes, it's got the copper belt underneath it, and it is sort of moving into that Mongolian space, excuse my pronunciation, the Ogotogo region, but it's an exploration company. And you can see the only price movement it's really had in the positive direction this year was when it came out with a quarterly cash flow update and also a mining exploration update. It looked like it was relatively larger than expected, but since then it's been moving back because it's stuck on the gold play. And the gold at the moment is unfortunately a really, really hard place to be in. And what's happening on Thursday morning is probably going to make it even harder with the fact that the Fed may taper, and that's going to be a bad thing for gold. Moving to probably the Stanmore side, and I'd probably more talk about that as a company and also the area. You've got to look at coal and where coal is heading. Asia has made up its mind that it doesn't really want to be, particularly in that thermal coal side. It is moving away from that as an energy source. You saw New Hope Corporation coming out today saying that market will remain quite depressed and moving into the future. They're not a place that they expect to get any better. Stanmore is in the same situation. It's under pressure from a market and an underlying commodity that is certainly out of favour and doesn't look like improving anytime soon. I think that's what you need to weigh up. Look at the underlying commodities that are in these companies, and for that reason, I'm really concerned about both. You may have to take the pain on both sides. Apologies.
On that note, we're taking a short break, but we will be back to answer more of your questions in just a moment. Welcome back to the show. If you have a question you'd like answered, there's no queues at the moment, so please pick up the phone and give us a call on 1300 30 34 35, or if you prefer, you can also email us on yourmoney@skynews.com.au. Now, before we went to the break, we did have a caller calling in about David Jones, and we didn't actually manage to get around to David Jones. And it's an interesting one, given that we have seen a lot of those cyclical players running pretty hard. So, David Jones, over in the US, we've seen Marcus Newman, I think, which was just sold for about 10 times EBITDA. And not too long ago, we saw another US department store being sold at about 11 times EBITDA. So looking at our department stores, I mean, is it time to be getting in? We know that consumer confidence the last couple of times has been running up. The property market has been running up. Surely the wealth effect has to hit soon. What do you think, Marcus?
I think there's a shorter term view and there's a longer term view. The shorter term view could be quite good for them because property prices are rising, and David Jones is in the really fortunate position of owning its beautiful building in Sydney CBD. And as you say, interest rates are low, house prices are moving up, and people are feeling wealthy. And David Jones' customers generally are, the more affluent in the country. So that could all be quite good for short-term trading. Longer term, I think you can't get away from the fact that retail in this country is getting disintermediated by the internet. and department stores themselves are quite tired in their offering. So not one that we would look at from the long side. We might actually even look at it from the short side on a fundamental
looking
view.
at it from the short side, would you agree, Evan?
I'm actually looking at it from a short-term perspective as well. I actually think it's probably on the way down, and the reason for it's been a standout performer. And I think Julia and I have had conversations like this in the mornings when we do our crosses together. And it's the consumer discretionary space is an absolute standout space since basically June. In saying that, we saw Myer coming out last week, and I think you need to compare what Myer does a little bit better also than David Jones lately. Now, David Jones does have a couple other abilities to probably leg higher, considering it has lagged Myer, and Myer has a couple other concerns. But you've got to look at the consumer, the retail sales numbers. They have been absolutely anemic over the last 5 months particularly. You've also got to look at the fact that Myer sees the current trading conditions as remaining very, very stagnant, and for that reason, when they come out with their results, which is next week, so the 25th, so that's Tuesday, be very, very aware Myer ran into their results and then sold off hard and has been selling off since. So from a short-term perspective, there is a sell the fact idea coming. Be aware that Myer had a fairly average result, and you would expect David Jones, unfortunately, probably to follow the same, considering they've actually had more sort of issues and concerns than Myer did over the last 52 weeks.
It's all about the top line as well. Like Mark McInnes, when he was CEO, did a fantastic job on just ripping costs out. And I think the cupboards are pretty there. So it really comes down to consumer confidence and
want to see the sales coming back for David Jones. So that was David Jones. Let's go to our next call. We've got Adam on the line from Sydney. Adam, welcome to the show. What's your question tonight?
Yeah, my question tonight was for Fortescue Metals. Sure. I was wondering, what are your thoughts on the growth between now and the end of the year?
Okay, Fortescue's been doing well. It's on a bit of a run. It's been ramping up, which means cost of production's coming down. It's paying off debt, and the most important thing, iron ore prices have been holding up. $135 US a ton. Marcus, would you be buying Fortescue? Or you don't like commodities?
I don't like commodities.
What do you think?
Like it's a high-cost producer. Which is bad when the price goes down, but it's good when the price goes up. But it's a commodity price taker. So it really depends on your view on iron ore, which is your view on China. If you look at the China electricity statistics, which many people say are the most pure form of monitoring the Chinese economy, it looks pretty good. But I've got no view. I don't think I have an edge in predicting commodity prices.
Would you be?
I do. I've got a view. Adam, you've got to have a look at what Fortescue's delivered over basically the last 10 years and what's starting to happen. This is what they're calling their magic year. 2013 was the year when they were going to hit 155 megatons per annum. It looks like they're going to do that. The Christmas Creek and also the King's Development Project well and truly on track. And you can see since that China turnaround story and the stabilisation call came about in June, Fortescue has been on an absolute tear. It's up 47%. Ride the momentum, be very aware it will pull back, but it is a stock that looks like it's reaching its goals. Momentum is there, Adam. It's something that I think you will really enjoy if you watch it very closely. Momentum is there, but nothing like the period from 2003 to 2007 where Fortescue was up 140,000%. So I guess it's the reason why a lot of viewers still are a big fan of the stock. Time for a short break, but we'll be back with more of your calls in just a minute. Welcome back to the program. It's the last segment of the night, so let's go straight to the next email, and we've got one here from Mark and Katie. Hi guys, love your show. I just bought 30,000 shares in Atlas Pearls and Perfumes as I think it's a good penny stock. What's your thoughts? Should I buy more? Also, what's the deal with Argent Minerals? To me, it has so much potential, but it keeps falling lower and lower. Thanks from Mark and Katie. Let's start off by having a look at Atlas Pearls and Perfumes. I think here in Australia, Pasquale dominates the industry. It makes up more than 90% of the industry. You can see I've got my pearls on at the moment. But they are facing some pretty stiff competition, and that's really because countries like Indonesia are starting to ramp up their game there. Dangerous industry, but it looks like Atlas Pearls and Perfumes have been going in the right direction. What do you think, Evan? Look, Mark, Kathy, I've got to be honest, it's a very small company at $14.3 million. Julia's right, it is in an area that it is on the way up, and that is Indonesia, which has a lower cost, but Pasquale is always going to be a hard one to get into the Australian market with. Looking at the actual market movements, it's been okay. It has moved up from 3.5 cents through to 5. if you are sort of looking at getting in, you've got to remember also it's incredibly illiquid stock. So understand that you're a long-term investor or a short one. I think on something like this, you would have to look at it very, very closely. And again, I would probably reiterate what Marcus said earlier in the night, and that is watch the bottom line. If the bottom line doesn't add up, it's probably not something to be in. So just be aware of that, and that's what I'll be watching quite closely.
Okay, what do you think about this one?
Oh, look, I've got to suggest it's not on my radar screen, this company. They've put out a good press release. It reads very well. But what I would say is have a look at the cash flows of the business, see whether or not it's in cash flow positive territory and if it can fund itself. So the best penny dreadful stocks, as I like to call them, are able to do that. So I'd direct you to that.
Okay, and let's go to our last caller of the night. We've got Andrew on the line from Queensland. Andrew, welcome to the show. What's your question tonight?
I was just wondering, do you know anything about Marion Energy?
Sure.
MEA is the code.
Andrew, are you in Marion Energy? When did you buy it?
MEA, yeah, we brought in, we got into them on a bit of a hot tip and haven't done a real lot.
Well, the stock hasn't really traded. I think MAE is the stock code there. For a couple of years, they've been trying to restructure, and I think maybe even, it hasn't traded, so we've got no chart for a company like this. But I guess it is a question about stocks and companies that do get into financial difficulty and may be offline for a number of years. I mean, you know, when it does come back online, I guess it depends on the debt restructuring deal. Have you ever dealt with distressed companies or companies that may be looking at restructuring their whole business? Are there any tips that you can give us?
We've looked at companies that have gone into a period. I mean, we were talking earlier in the evening about the salary packaging business. And they actually had to go into a release for nearly a month after Rudd came out with his salary packaging legislation. So, but the underlying business itself was quite good, so it's recovered. It really comes down to what you've got.
Okay, on that note, that's really all we have time for today. Thanks so much to our guests. Fantastic show tonight. Evan Lucas from IG Marcus and Marcus Hughes, it was your first time on the show.
Thanks
Great
for having
performance from LHC Capital if you're interested in following Marcus, and to you, our viewers, for all your calls and your emails tonight. Until next week, I'm Julia Lee. Have a great night.
The information featured in this program is general in nature and therefore should not be relied upon. Guests appearing on the program may have commercial arrangements with some of the companies mentioned. Before making any investment, insurance or financial planning decisions, you should consult a licensed professional who can advise whether your decision is appropriate for you.